Hi everyone. So today we're gonna do a video on personal finance. This topic is actually quite interesting. So when I moved to the United States, I was actually kind of shocked that the educational system here didn't actually highlight any points on personal finance. Now, they focus on things like accounting, corporate finance, but no one really talks about personal finance. So what do I mean by that? It's like once you go out and you start working, all that money that comes in, people usually just don't know what to do with it, which is kind of shocking because like the first thing people would probably want to do is, use that money to buy things that are, make them feel good. And in the long term, that may not be the best thing to do with the money. Um, and some I've seen cases where it was actually kind of funny, or not really funny, but it's kind of weird when you can see someone that is, helping corporate finance or corporate companies that are public do accounting or be the controller, but yet they don't know a thing about their own income tax, um, which is kind of like, what? But anyways, I'm not gonna go on that topic. So today we're gonna be focusing on what I feel is kind of important points to focus on personal finance, at least the very basic steps of it. So if we get these points down at the very least, then we can move on to more advanced topics.
All right, are you ready? So, the first thing we have to think about in personal finance is trying to subdivide this topic into two buckets. One being the short term, and the other being the long term. So, let's highlight some things in the short term. When we talk about short term things to consider, these are by nature more of things that are like happening right now or things that are maximum, say, 1 to 3 years. So some of these items that you should definitely consider in personal finance, at the very least, should be as such. So one of the first items I would actually do is to ensure that you have a good picture of your current financial position. Now, in order to do that, you have to have a good idea of what your net worth is. So net worth is pretty much at any point in time, or at the time you do this calculation, you take your total assets, which is pretty much your cash, how much you own, and all the fun stuff that is worth money. You take that snapshot at that point in time, and then you less all the liabilities that you, long-term liabilities that you're on the hook for, and then you just basically net out the two to find what are you actually worth. So in a very layman's term, essentially that is taking everything that you own, or at least it's easy to liquidate, and giving a number to that, minus all the debt that you own. For example, if I own a house, I could go to Zillow or Realtor.com and get an estimate of what my house is worth. But then I have to make sure to net out what I owe to the mortgage company, because the equity that I have in there, that portion, that little sliver of equity, that's what effectively would be part of a net positive, assuming your house appreciated to your net worth. Now, we should also get into more complicated things, but let's keep it very simple. I would recommend you to list out everything from the income source, as in cash, dividend income or royalties or investment properties that, giving you cash. Get all the cash, consolidate it, boom. That's one thing in the assets. Liabilities will probably be things such as like your credit card debt at that point in time. So I highly recommend you take your credit card balances at that point in time and add that as a liability. Same thing goes as your mortgage, add that as a liability. And then you net it out to get your net worth. So this gives us a really clear picture of if you were to go, say, sell everything out and move to, really far away, you know how much you're worth. I won't dive too deep onto how to structure a net worth, but maybe on subsequent videos, we'll create a net worth type of cash flow ourselves, or a summary together. The second element I would definitely focus on would be a well-established emergency fund. So what is an emergency fund? Well, the name pretty much tells itself. It's effectively a fund that you have in case of an emergency. So in this case, I would recommend you to have roughly 3 to 6 months worth of monthly expenses saved up in cash. Also include the deductibles that you owe on insurance. So what is a deductible, by the way? So a deductible is basically the amount of money you must fork out until the insurance will pay the rest. So this covers, our health status or health situation, and also covers our our day-to-day spending. Now, this does not include your shopping sprees or entertainment. Literally, your emergency fund is what do I need bare minimum to survive for 6 to 3 months in order to get my next job. You should also, as a pro tip, if you have kids, make sure to include their daycare cost in there, because the last thing you want to do when you're unemployed or have some emergency is to not be able to send your kids to daycare and cause additional load up on your already stressed life. Like, once again, we could actually, on my subsequent videos, I'll help go with you, walk you through on building actual emergency funds and see how we can build one up. But for now, we're just gonna go through a very high level explaining what these elements are. So the third item I would focus on when you should think about short term is, let's think about or create some sort of budget for this particular month. So in order to do a budget, I know sometimes it may sound very difficult, but it really isn't. You simply, one thing I like to do is, if I can't estimate a particular line item, I could just look at my, what I paid my credit card last month, or look at my bank account, all the negatives, like what did I pay? So you can list off all the things by category, like what are all your monthly expenses on your house, daycare, transportation, commute. By creating this budget, it allows you to really understand your current financial position, because it looks you like you can actually see, well, I'm bringing in X amount of dollars. However, why am I spending Y amount of money? And then you start building these more detailed buckets, explaining on subcategories like what my budget is. And once you start get that initial step to get your personal budget down pat, you only need to come revisit this maybe once a month. This is a good exercise not only to manage your own cash flow, but it's very good exercise to track, like, if anything, there's fraudulent things happening on your account. Because this has happened to me once, where I wasn't looking at my monthly budget, and I noticed after 2-3 months, when I started going back into it, there was a really awkward charge on one of my credit cards. When I investigated further, it was actually, I got some fraudulent charges all the way in Japan, somewhere far away. So these things you start picking up once you create your budgets. And I highly recommend at the end of the month, you not only do the budget, you'll see some, like, trying to link it towards your actuals and see how you're actually doing. And ideally, given your budget, if you outperform, you go almost like treat it like a game. If you spend under your budget, that means you have more money to toss to the long-term type of exercise and long-term things. But when we look at long-term elements, the first thing we gotta think about is, like, what kind of retirement lifestyle do we want, right? When we look at retirement lifestyle, so one of the things that you can do is pretty much take what you're spending right now. Do you want to maintain it? If you do, or do you want to up it and add a vacation to it? Great. Take that, and juice it up by the inflation rate on when you anticipate to retire. That's pretty much about, and then come up with a number. We'll go through an exercise later on in other videos to actually get this number, but get that number, and then you could just pretty much, like, that's your and then present value that, and that'll be your ultimate goal to get to. So you know that when you retire, some of you might want to retire in 60, some might be 35 or 40. You just have to determine what kind of lifestyle you want when you retire. And then once you have that much capital in there, then you'll be like, all right, cool. I'm good to retire and I could just enjoy life. So retirement is very critical. One of the actually cool things about retirement is that we have a lot of vehicles in the system right now that can help. That is very tax efficient. Some things to note, if you qualify, for example, for a 401k company match, that is definitely one of the top priorities you should top up with. If you have a company match, it's pretty much 100% gain. Like, you can't get that on the market. You need to go and secure that company match 401k immediately. Another thing is, like, okay, well, other programs will be like tax deferral. So meaning that you don't have to pay your taxes right now. You could pay it when you retire, right? You could defer some of those. So you could put it into a regular 401k. Other things that are really cool that I think you guys should definitely consider is if you qualify, get a Roth IRA. And if you're in Canada, that's more like a TFSA. But what this essentially you're doing is basically putting after-tax dollars into an account, but any capital gains beyond that account is tax-free. It's like free money. That's really powerful, especially if you put on stocks. Imagine, on historically speaking, every year they roughly earn about 8%. You're looking at big bucks on there. Now, for those who don't qualify for Roth IRA, there's still a solution, and that is called something through a traditional IRA after tax. You open one of those accounts and you transfer that balance directly into a Roth IRA. Now, I know on the internet that sometimes they call this the backdoor Roth IRA. It's totally legal, and we could dive deeper in subsequent videos. But seeing that this video is getting a little bit long, these are just some of the strategies that you can help improve your own tax position and retirement lifestyle vehicles. Another thing, finally, point number 2, would be legacy. You gotta think about legacy if you want to leave legacy. If you have kids, or if you want to just find your place that you want to donate to, having a legacy strategy would be great. This will probably be thinking about like how you want to set up your insurance, set up a trust, set up irrevocable, like all these different elements that you can think about once you pass away or go to the ground. You don't want all that money to just go to the government. Maybe you do. Maybe you want to go donate that money to government. That's cool too. But you probably want to have some sort of strategy behind that, so you can leave that legacy to someone or some organization. Right? We'll work through that again, like I said, on subsequent videos. But for now, let's move on to the next. And the final thing for long-term wise, I was kind of bent between deciding if this is long-term or short-term, but this is your 30-year, 25-year, 20-year, mortgage. Now, I know a lot of us, even, a lot of finance gurus will say like, okay, I'm borrowing at, 3.5%, or in this low interest rate environment, I'm borrowing such a low percent. Why would I pay it off, right? In some facts, yeah, that's true. However, in the same context, you got to put in mindset. I'm borrowing this to him from a show that I always watch from Dave Ramsey, but imagine like, would you leverage your house right now, or put your house and go to the bank and like get a HELOC or get some sort of leverage and take that money and buy your car, or go and take that money, like leverage your house and buy stocks? Would you do that? That's really risky, right? And I personally would recommend to pay off the mortgage as soon as possible if you can. Why I say this is because if you know how amortization works, until you get to the midpoint of your principal and interest payments, the first 10 years or so of your 30-year, 15-year mortgage would be highly skewed towards interest. What does that actually mean? It means that, say you pay a $2,000 monthly mortgage payment, about 60%, so like around 1,200-ish of that is going straightly to interest. You're not getting any principal. Basically, you have no principal accumulating for the first couple of years, and then after that middle point, then they start having one-to-one, and then skewing it more towards your house. So what does that really mean? It means that if you bought a house, for $1 million or something like that, and you have like a really ridiculous mortgage, say 3 years down the road there's a recession that hits, and your value of your house goes down, well, you have no principal. You're stuck. You're screwed. So I highly recommend to consider, and we'll talk more about these mortgage things at later videos, but I highly recommend to pay those off soon than later, and really manage your debt. Ideally, you won't have no debt, because if you think about it, a lot of folks that are rich, they really don't have that much personal debt. They may have company debt, right, but they don't have personal debt, or very little of personal debt. There's a very big difference between that. Now, I know this video has gotten a little bit too long, so I'm going to try to consolidate and close this a little bit. If you guys like these type of videos of explaining some of these financial aspects, let me know. Hit a subscribe and a thumbs up, and I'll make more of these videos. But I thought this is just like a good warm up just to get an introduction about this topic, because I feel that These type of topics are very important, and everybody should know about it. If not, this is probably the number one thing you should consider thinking about. Okay.